Howdy there, folks. Welcome into today's video. Very interesting one. There's one video I want to react to here in this video. The big warning from the charts. If Apple goes to $100, what does it mean for the markets? I actually watched this live. I want to react to that with you guys. I think there were some important points made, and I want to kind of talk about that and react to that in this video. But before we get into that, there was a lot of big name stocks that hit new lows here today. I'm talking Tesla, I'm talking Palantir, I'm talking Amazon, a lot of huge name stocks. And I just want to quickly give an opinion right off the bat here on my opinion on what's going on with those stocks and kind of where those stocks are headed here before we get into that reaction. So first off, I appreciate everybody joining me as always. 19,900 plus subscribers now at this channel. It is absolutely amazing. So I am very thankful everybody's enjoying the reaction channel, and thanks for always joining me, okay? First off, Tesla. Okay, so the stock hit a new low here today. It is down 62.5% now year to date. Now, something very interesting happened with Tesla stock. Before I went to bed, and I go to bed like insanely late, like many times it's like 2, 3, 4 in the morning. What I noticed was in the way pre-market, essentially, Tesla was trading up, and it was at like $157 before I went to bed, roughly. And the stock was up like 5%-ish, somewhere around there. And it was interesting because I was watching that, and I was like, oh, maybe they'll try to get some short-term pop out of this, some oversold bounce, because obviously Elon might end up eventually stepping down from the Twitter CEO position whenever that happens, right? So maybe they'll try, and they tried to get some sort of like short-term pop, but ultimately it didn't produce anything. Like it just, the initial pop there that happened, it just ended up being sold. It didn't try to come back and then just got sold off again. And so a stock like this, it has kind of three problems going against it in the short term. One is absolutely the Elon drama. Now, that's not the only reason. That's just a part of the reason, right? The whole Elon drama, the Twitter, all that stuff, okay? The second reason is definitely some sort of tax loss harvesting, right? I mean, if you bought the stock in the past 2 years, you're down. And you're down likely a lot on the stock if you pull up a 2-year chart in this one, right? For those of us that have been in the stock for many, many years, like 4 years, 5 years, we're up massively, right? But for a lot of folks, that's not the situation. They're down massively, right? And so there's some sort of tax loss harvesting. But the biggest component why you're continuing to see selling pressure on Tesla stock and people continuing to dump these shares, the main reason over all the others is the flat out truth about where the economy is going in 2023. And there's more and more concerns that the economy is going to fall off the rails in 2023 and is already starting. And what does that mean for a company that is expected to have 40% growth by analysts on average, right? 40% revenue growth, and you sell autos? It's not going to be a good environment for the next 1 to 2 years for a company like Tesla. If you're talking about major weakness, Tesla has grown up its entire basically cycle in a growing economy where everything's getting better and better and people taking out debt, right? I mean, Model S hit the market in 2012. And so Tesla's only seen a good economy since they've been like a developed company, right? And actually got the S out there, the X out there, the 3, the Y. And what does that mean for Tesla in a contracting, a worse economy, right? Something that's good and getting much worse. And that's something we got to see play out in the numbers. And that's the main reason the stock just continues to have selling pressure on it. I could imagine the selling pressure probably stays on for a bit, maybe into Q1, Q2. And eventually the stock will have a capitulation type sell-off. I think that's when the capitulation type sell-off, in my opinion, that final last hurrah, I think that would happen when everybody kind of recognizes that, oh, they might not get anywhere close to 40% to 50% growth like analysts and Elon Musk usually have for this company. I think once that happens, you'll have that last kind of capitulation sell-off of some just ridiculous stock price, and people just looking at it as like the risk reward's too great on a 5-year cycle. Right now, people are still concerned, but eventually it gets to that sort of price. Anywhere between $90 and $130, I think, is that sort of price around the stock. And likely Tesla will be a stock I start buying again in 2023. PayPal, pretty much right around lows in regards to that one, right? Apple stock continues to get very, very close to lows. We're going to talk about Apple, so I'll save my opinions on Apple in just a moment and where I think the bottom's at for that one, right? Shopify's come back a bit from those lows it reached back in kind of October, around $25 or so. So do keep that in mind for a stock like that. QQQ, that baby's down about almost 33% so far this year, right? 32.8%. It's been awful. Nvidia's come back a bit. If you look at a stock like AMD, it's not quite at the lows, but can AMD get back down to that $50-something range? Absolutely. I mean, worst case scenario I see for AMD's in the 40s. And I think that is a possibility in the first couple quarters of 2023 if they really continue to sell that baby off. Okay, Amazon hit a new low here today. Again, that's just been brutal. I mean, the stock's down over 50% now. It's been cut in half. It's lost from the highs. Amazon's lost about $1 trillion of market cap, which is an absolutely insane number. With obviously so many worries about the economy, it's not gonna be the best situation for Amazon, right? They've become so big now at this point in time. They're one of the biggest revenue companies, if not the biggest revenue company, thinking about it now, in the entire world. When you become that, now you become so dependent upon the economy growing all the time that I think Amazon's going to have a struggle of a year in 2023 when it comes to numbers. But man, is it a great year to be a long-term buyer of so many of these stocks. You know, the Teslas, the Amazons, these sorts of companies, AMD, maybe even NVIDIA. I mean, it's going to be a great year to be a buyer of these if you have a long-term outlook. Meta's the same exact thing. This one's quite a ways off of that insane capitulation sell-off, $88. And that's the type of sell-off I'm talking about. When I talk about some of these other stocks still have this capitulation type sell-off to go. Tesla, you know, Apple, even maybe Google, Amazon, you know, Amazon's getting close to a capitulation type sell-off, but you get down to just some silly pricing, right? You know, Netflix, this happened back in the summertime, and Netflix went all the way down to $100 and something a share, right? 160, 170 bucks a share. That's a capitulation, insanity type sell-off I'm talking about, okay? And if we want to talk about Palantir, right? Good old PLTR, Palantir somewhere in here, and that is a stock I bought some shares of in the 7s, and now it's in the 6s, right? And I wouldn't be surprised if before it's all said and done, it goes to the 5s, to be quite honest, right? The great thing for Palantir is regardless of pretty much what happens, they're going to find ways to grow that business. It's just right now, the issue is, I'm sure you got some tax loss harvesting going on in regards to Palantir, but the main issue with Palantir, for all Palantir bulls out there, the main issue Palantir has right now is the sales cycle process, especially when it comes to selling to companies, is a slow grinding process and likely will be for this next year. Basically, how companies are running their businesses now is if you want to get some sort of new product or service or whatever, right, and could be a Palantir. Now it's having to go way up the ranks to even sometimes CFOs, chief financial officers, or CEOs, chief executive officers now. Whereas before you could have maybe lower level managers or lower level executives sign off on some of these deals. Now it's having to go all the way up because companies are really watching their budgets over this next year with all the recession fears. And so that creates a dilemma for Palantir where the sales cycle might just take longer. The great news for Palantir is they have an amazing product. At the end of the day, there's going to be countless Fortune 500 companies that continue to sign up for their product, right? So for long-term investors, you know, to be able to pick up the stock at $5, $6, $7 should be looked at as kind of a blessing, right? And the balance sheet's in an incredible position, $2 billion plus of cash, no debt. If you're talking about going into a recessionary scenario, that's pretty good. And when you have a big government business, which is stable regardless of what happens in the economy, government business is stable, that's obviously a good thing as well, okay? And so that's kind of my opinion on those ones there, okay? Now, let's go ahead and jump into this here and talk a bit about the market warning.
All the pieces that should be supporting the sector seem to be falling into place lately. First, interest rates have been dropping sharply. The yield on 10-year Treasury is down 75 basis points from its October high. Traditionally, lower rates are good for growth stocks. Then there's a dollar, also down almost 9%, in fact, since September. And inflation, signs emerging that pricing pressures are abating. The consumer price index lower 5 months in a row now. All of that should give a boost to the growth trade, but not this time. The ARK Innovation ETF, for example, losing 2/3 of its value already this year and hitting an all-time low today. And it's not just the highly speculative names that are struggling. Apple dropping more than 1.5% today and is now just 2% from June lows. One of our traders tonight has a stark warning about just how much lower this one-time tech stalwart could go. Let's go to Chris Verone and his charts. Chris, what are you looking at?
Hey, Melissa, yeah, I think it's such a great lead because when we think about what's happened over the last week, everything has been so bullish for growth stocks, but they can't respond to it. Over the last 2 months, you have rates down, you have dollar down, you have softer inflation, but the big weights, especially Apple, unable to respond here. And I think what's really notable,
we call that a market moving from inflationary worries, right? And that's the element of what the market is paying attention to in 2023 to now we're getting the recession worries. So the theme of the stock market is changing. I think it's important for everybody to understand this. And so what was looked at as good and what was looked at as bad in 2022 will not be the same things that are looked at as good or bad in 2023. We got a whole different dynamic here. there's certain things the market wanted this year, right? That if it got those, it was seen as good news, and certain things that if it got that, it was bad news. And this year, at the end of the day, bad news is going to be bad news. And good news will be good news, but it's just a question of how much good news do we actually get this year, okay? And so I think that's a very important point to kind of bring out there.
Still hasn't changed its opinion of the stock yet. There's 45 analysts who cover Apple. The stock's down 30 or 40% from the highs. You still have 37 of 45 analysts and a price target of $173. Everyone is still a buy on the name. I think you have to see more pessimism come into the name before it's buyable. We think that happens lower. And when you consider the longer term picture here of what the chart is actually telling us, here's the last 2 years.
So the reason that's so important, what he just showed, is that shows you how many analysts are going to have to bring down their stock price targets, and honestly, they're strong buys to buys. And I've been talking about this, and this is something all these like Dow stocks, all these S&P 500 stocks are going to have to go through in 2023, and it's going to be a painful process to go through that, and analysts downgrade after downgrade after downgrade and bring down numbers again and again and again. Ugh.
This looks like one big rolling top formation to us. I thought breaking below that 135 level, which has been support really all year, is a very important development today, closing 132.37. And, when you take a little bit of a longer step back, look at the last 4 or 5 years here when it comes to the Apple name. Think 12/31/19, before COVID, the stock was $75. So many of these big tech names have simply returned to where they were pre-COVID.
Many of them are way lower than they were prior to COVID. Meta definitely comes to mind, right? So that's something to keep in mind. And yeah, is Apple going back there? I would say 50-50. Is Apple going under 100? I would say probably about an 80% probability. I would slap on that. So that's a lot of downside. I mean, if you're talking about from 130 to 1, it's 30% downside roughly. If you're talking about going under 100,
75 to 100 for Apple. And if we take a step back and just look bigger picture, these names, these big tech names, these big growth weights are still too big. This is the combined weight of the 6 largest issues on 12/31/21 at the start of this year. There's still 25% of the S&P. I think ultimately this goes lower. These bear markets don't end until the best names get hit. That's Apple for us. I like 100.
100. All right, Chris, make your way back to the desk. Steve Grasso, what do you think of this forecast?
Yeah, so I do like how Chris finished off that, because that's how you know that people are throwing out everything. When they sell what they love, when they sell the real rock of Gibraltar names. That's Apple. They haven't done that yet. Amazon is at the COVID level. Apple's not.
Yeah.
Nowhere near it. So Apple was what, 50 something? I know that you had said it before, but you're talking about pre-COVID levels.
Now you might be asking yourself, why is Apple not at those lows that these other stocks are at so far, right? And the reason being is Apple was able to hold up their numbers better than everybody else in 2022. Unfortunately, that's going to end here in 2023, but they were able to hold it off better. Whereas Amazon, Meta, these other companies, they deteriorated their earnings faster than a stock like Apple, right? Which kind of makes sense, because if you look at stocks like whether it be an Amazon or a Meta or some of those sorts of stocks, right? They're seen as like higher risk, higher reward plays than an Apple. And so it kind of makes sense that an Apple is going to hold on to their earnings a little better. But at the end of the day, by the end of the story, it all ends up down.
Talking about the COVID low was in the high 50s for Apple. People, if that were the case, where would the market be?
Oh, I mean,
right? So
much lower.
Much lower. But if you look at the last time that Apple was at this level, or if it goes to 100, the S&P was at 3,200. 3,250, 3,300. Everyone on the street that's negative has those targets in for the S&P.
Right.
Well, that's how you get there. It has to come from the big weights, because we've already seen the marginal weights, the ARC stocks, the smaller cap names down 50, 60, 70 this year. So it's not coming from there anymore. When you look at the top of the market, these big growth stocks, rates down, dollar down, softer inflation, softer growth, that should have been the perfect cocktail for these names to work. They've given us nothing here. When the market doesn't respond like the consensus believes it should, that's a really important message. So I think the weakness in that is telling us that something with the macro is still not right here.
Karen, would you sell?
Would I sell? No, but I understand what you're saying. I do think that the buy side, the sell side rather, being all positive is a negative.
Yeah.
Right? Because there's no incremental new positive to come in. So and we're going to see some negatives. I do just want to push back a little on how much.
Something extremely important to remember with stocks, and I want everybody to remember this point because it just got me thinking about, sell side, buy side. What happens always is stocks way overshoot on both sides. So when everything's going great, when business is growing, analysts way overshoot price targets, way overshoot the overall positivity around the stock. And on the other side, the same thing happens. So when you're talking about a lot of these companies, the Amazons, Apples, any of these, they're going to overshoot to the downside. That's what happens. And so that's just some food for thought there, that even if Apple maybe should only go to, let's say, $100, they could easily go down to $80, $70, $60, which I know is crazy to even think about. But it's a potential. It's a realistic potential. I think that's what's important for everybody watching this to understand.
Money they have made since, right, over the last several years. That's one thing. And the second is the business.
All the money they made. The problem with that is they've spent so much of it between the dividends and the share buybacks. They've I don't want to say they've blown all that money, but they've spent so dang much of it, right? Never mind on new corporate headquarters and a ton of employees and all that stuff.
Changed somewhat, right? We know services was really it was pretty marginal. Now it's becoming a much bigger part of the business. And so to me, that seems like it deserves somewhat of a higher multiple. But do you feel like those two factors in what you're looking at don't matter? No, I'm not asking sarcastically. They may not matter at all.
Well, I think, number one, when we look at the picture, right, the chart's not pretty. But let's talk about it from a multiple perspective. I still think trading 21, 22 times next year, which is above a market multiple of 17, 18 times here. So it's still trading at a premium with all the China exposure.
Yeah, and the problem is the whole market multiple, especially around Dow and S&P, needs to come way down from where it's at. So, that's the other ugly part.
I would be of the view if you have big China exposure, you should be trading at a discount to the S&P here. So it's I think some inconvenient messages like that leave us more on the bearish side of the stock.
Which a lot of us have been saying for a while, that stocks that have significant exposure to China should trade at some sort of a discount for some time. And just because China has opened up, it doesn't mean that they're China woes in terms of their exposure in manufacturing there, or just to the consumer there, which may be impacted by COVID. I mean, that certainly doesn't go away. Julie, where would you stand here on Apple? It does make sense as the market overall, if we believe that there should be a reset on valuations overall, that it's got to come from the biggest part of the markets. That has to join in on this fund.
Yeah, I agree. It has to be a part of the situation in terms of, especially what I would expect in terms of the earnings revisions. And, I think investors today are recognizing that not all tech is the same, and a maker of cell phones, $1,000 cell phones, could be really challenged in the next year if consumers continue to get softer and softer. So I personally think it's just a recognition of the fundamentals. That said, I agree that it's one of the highest quality names, and its business has moved towards stickier services. So I wouldn't be a seller at this level, but I do recognize that I think that's why we haven't seen the stock work really well in the face of better, indicators like inflation and a dollar.
I don't know if you guys saw my video I put out maybe a few days ago, but I showed something very important regarding Apple. And that was Google Trends data. And as we always say, Google Trends is our friend. iPhone, Google Trends not looking good at all. MacBook, Google Trends falling off big time. iPad not looking good. AirPods not looking good. Any of the Google Trends data in regards to Apple-related products has definitely fallen quite considerably recently, which definitely doesn't bode well. And then you tack on consumers not having money, right? And also worries, like none of that bodes well for Apple. Plus, they've had record year after record year after record year, 2020 record year, 2021 record year, 2022 record year, right? Not ideal to go record into a horrible economic kind of backdrop here over this next 1 to 2 years.
Chris, so what other large cap tech stocks need to join in on the party that haven't already?
Well, I'll make 2 points. Number one, just on the idea that services are stickier. Mm-hmm. We don't know that. The service line.
I agree with you. By the
service line of Apple is a kind of a,
may not be
a post-2008 phenomenon. So I don't think it's really stress tested in what a proper recession or slowdown may look like here. And when you talk about the big weights, Microsoft has largely escaped much of the selling here. Again, I keep going back to the idea you don't get through these bear markets until the best ones get hit. So I would put Microsoft still in that camp here as well.
Well, Microsoft was one of many stocks I talked about on my big video I put on the main channel here today, which, by the way, if you haven't got to check out that video on my main channel, Financial Education, check out that video. That is maybe my best video of the entire year, in my opinion. That's definitely one to check out, and I gave my opinion on Microsoft and kind of what I see with that one.
One little add on to this. So Apple is included in 299 ETFs. And they have, in the top 3 or 4, they have an above 20% rating in those ETFs. So when you start
you mean above 20% of the holding?
Just Apple.
Of the weight.
Yep.
Okay.
Of the weight inside that
rating.
ETF.
Yeah, exactly. It did sound like rating. I was like, weighting, meaning essentially, if Apple's just dropping any significant weight, those babies would go down like a Titanic.
No, waiting. So what happens when you get all of that?
Hey, one of my dividend stocks did well today. Woo, Walgreens.
Automatic forced selling when people try to sell their
Oh, you'll see a lot more of that. You'll see a lot more of that, baby, over this next year.
Apple. Like a lot of times it mirrors one, it mirrors the other. It becomes a
it helps on the way up.
Exactly.
So,
well, there's 2 parts of this, and if we use the experience of the 2000, 2001, 2000,
that's one I haven't even thought about. Disney touches 52-week low. I mean, that's a potential. It's a potential. I might get in, but I don't even know, man. Disney's such a great company, but man, have they loaded up that balance sheet on debt. And when you look into 2023, there's so many deals on so many great companies. Like, is Disney really the one I want to touch when everything else is down 50, 60, 70% and much better balance sheets and probably much better income statements over the next 5-10 years? I don't know.
Bear market. There were 2 phases to that bear market. The big weights underperformed on the way down. But then when the cycle turned, they also underperformed on the way up, right? So that you didn't go back to the same names as your leadership. So let's just say S&P bottom today. It's over. Bear market's over. That doesn't mean we're going back to Amazon, Apple, Meta, Google as your leadership on the other side of this. I think it's a really important point thinking about 23. So you can be wrong on the market call, but actually be right on the leadership.
I totally see that. If you think about what we're returning to, why should we return to the same leadership if the environment is completely different? If money is no longer free, if inflation is higher than 2%, all of these things have changed. And so why should the market leadership be the same? Why should there be a reversion to that norm, Karen?
Well, if I look at, Google, my biggest position, right? There has been a big move in Google down. And I think that the valuation here is nowhere near what it was. And I think that the balance sheet is extraordinary. So I don't, maybe it doesn't get the super premium that it got, but I still think that it absolutely deserves a premium. The moat there is huge. And just looking at it on valuation, only on valuation, to me, it's very compelling.
So maybe tech overall?
Absolutely. So I agree with her on that. The one point I'll push back on, right? You see the stock at roughly an 18 forward P. I mean, in those markets, we've seen forward Ps kind of thrown out, right? Meta got down to like an 11 forward P at one point, right? Imagine if Google was to go down to an 11. That's a long drop from here, right? That's like another 30%-ish drop from here, if not more than that. So that's something to keep in mind. Although a lot of these stocks, it's like, man, they're starting to get really cheap on valuation basis. Doesn't mean it can't actually get a lot worse when it comes to valuation, because we've seen that with a lot of these companies, to be quite frank. So, but Google is a great long-term buy for investors in 2023.
Isn't a leader in the market, isn't the leadership, Julie, but maybe some tech stocks are still great. They will be leaders individually. What do you think?
Yeah, absolutely. I agree. I think, your consumer-driven tech names were what really led us out of the pandemic. And I don't think they're going to be the best places to be in 2023. I would rather have smaller niche software businesses that are mission critical and don't have the same level of regulatory scrutiny that these large tech players do have. I think they're better able to manage through a difficult environment, and the stuff that they sell, you need it. Netflix, I love it, but I don't need it.
When you look at it, though, so here's the problem I have with new leadership.
I don't know about that. I'm not even a fan of Netflix at all, but people that love Netflix aren't getting rid of that dang thing, okay? I don't know about all that.
Where does it come from? So if you have, let me finish.
Thank you.
All right.
So if you have, as I said, with the ETFs, they all own those top 6 names. So when more and more people are passively investing. So when they passively invest, they have to buy those 6 names in tech. They're not buying the esoteric, low cap names or market cap names. Where's it come from?
Well, I think behaviorally, right, it's a lot easier for the large cap growth.
The whole passive investing thing, just throw money in index funds, right? So hyped right now. So hyped. More than I've ever seen it ever before, right? And we've had some very famous, very high quality investors basically talking down about this whole just throw money in an index fund and passive investing, right? And no one's even listened to those folks. No one's even talked about that, right? And with individual stocks doing so poorly, a lot of people are like, look at the indexes, S&P's only down 20% or so, and the Dow's only down this and that. And so everybody looks at that. But, if we're going to major crash, believe me, the Dow and the S&P will get hit nasty. And then that will throw out the passive investing. And it feels like this market wants to destroy everybody. It wants to destroy the individual stock pickers. It wants to destroy the real estate folks, which that's just starting to play out, right? It wants to destroy the crypto folks, which has already done that a long time ago, right? It wants to destroy even the passive investors. And when you get through one of these nasty markets, it destroys everybody by the end of it, right? That's why when I got in the market, end of 2008 and going into 2009, and just talking about the stock market, no one said anything positive to me about getting in the market. No one. Only indifferent or negative things. Why was that? Because everybody got wrecked even if you passively invested into the indexes. They all fell 50+%. Every single index. So everything is hyped and talked about and so great until it comes crashing down. And then it's a scam and it doesn't work and it's a bad idea. Same thing again and again and again and again. And the other reason indexes have been hyped so much is because it's lazy work. It's lazy. Like, people don't have to put in any work. You don't have to worry about it. You haven't had to worry about it until the economy comes crashing down and valuations come crashing down, all the cheap money goes away. Then you have to worry about it. But everybody loves an opportunity to just make money the easy way. Make money the easy way, right? Who doesn't? Why do you think so many people are sticking money in Bitcoin and Ethereum over the past few years? Because it looked like it was easy money. You didn't have to research anything. It's just like, oh yeah, Bitcoin's the future, Ethereum's, throw money there, throw money here, throw money there, throw money there. Everybody likes the chance of easy money. And index funds have given the promise of easy money. And when you have people just talking about it over and over again, even some of the greatest investors in the world have kind of warned against this and warned that it's going to be a problem. Time just has to play out in all those situations, right? It just takes time.
To say, okay, I'm going to get smaller in my Amazon and my Google and my Apple, and I'll buy Bristol Myers or more. Like, that's a logical move into healthcare. And I think the charts have reflected that. But we've looked at this, right? If you look at the 10 largest stocks at the end of every decade, going back the last 100 years, they're not the 10 largest stocks 10 years forward, right?
So, good point.
So which are the next 10 largest stocks?
Don't we find it really curious how well the industrials act through all of this, right? Those used to be a much larger weight in the S&P. So if we're looking to identify candidates on the other...
Wait a minute. If you watched my video earlier today, you know exactly where I'm going with this one. Those sorts of stocks are the freight train. They have the freight train effect. They take a lot longer to start to fall and start coming back when the market starts to end up recovering. And so if you're looking at many of those stocks, don't be surprised if a lot of those get hit heavily in 2023 at different time periods. And that's just the way it will be. And a lot of tech stocks, NASDAQ type stocks, those ones are fast. When things are getting bad, they go bad fast. And then when things just start getting a little bit better, they react fast on the upside, man. Whereas a lot of those other stocks, they are so slow moving. They're the freight trains.
Let's at least put that on the list of what it could be going forward.
Karen, that's like music to your ears.
I know. I love that. Right. Oh, my God. United Rentals had a great year. I mean, the infrastructure bill, maybe that's part of it. So we've seen... It's been
all those companies have benefited massively from record construction. Most homes ever being built, most apartment buildings ever being built, most warehouses, all that stuff, right? They've all benefited in a massive way in 2022. But the problem is the backlog is starting to shrink for everything. And it's going to get a lot worse in 2023. And going into 2024, for new construction, the backlog is going to be dried up.
Decent place to hide. That and Big Cap Pharma, that makes sense to me as well.
No. It might have been a good place to hide this year with that massive backlog of just insane amounts of homes and apartments and all that being built. But I'm telling you, if you think that's the place to hide over this next year, you're in for a rude awakening. Because as 2023 is going to tick along, construction is going to start going like this. And you're already seeing it. Toll Brother backlogs already was down like 21% in terms of amounts of homes. Imagine where it's going to be by this time next year for Toll Brothers and KB Homes and all these home builders in the apartment. And just you go through the entire construction wave. So I think that's just a very important factor that a lot of people are overlooking in this market. Definitely, if you haven't already checked out my video I put out on the main channel today, check that baby out. That one talks about, the recession is not priced in. And that is a must watch. And anyways, appreciate y'all. Much love as always. Thanks for being subscribed. 19,900 plus subscribers. And have a great day.